Hello, my name is Juan Alaniz, and today I'll be presenting FMS Securities Return and Risk Analysis. Why is a T-bond return independent of the state of the economy? Well, the U.S. Treasury bond is used as the risk-free rate, and that is because it is one of the safest investments in the world, uh, meaning that even if the economy takes a downturn, the U.S. government will still pay the bond. It has a very low risk of default. Uh, with that said, it isn't 100% risk free. It doesn't take into consideration inflation risk. Which potential investment appears to be the best? In the table here, we calculated the expected rate of return, and the S&P outperformed the rest at 9%, followed by Entergy at 7.5, followed by Freeport at 5.9, and finally the T-bond at 3%. How do the alternatives compare when risk is considered? In this table here, we calculated the standard deviation, which measures the volatility of the stock in comparison to the average return. Then we divided it by the average return and got the coefficient of variation, which weighs that out to the size of the stock. So it is more accurate than the standard deviation alone. From this, we can see that although the S&P had a higher rate of return, it also has more volatility, more risk than the rest. Uh, Entergy had a lower standard deviation and a lower coefficient of variation in comparison. In this table here, we took into consideration a portfolio that is made up 50-50 of Entergy and Freeport. As we can see in the table, the standard deviation and coefficient of variance significantly dropped from the stocks individually. That is because these two stocks have a negative correlation with each other and made them optimal for diversification. So it contains less risk together than alone. This table here takes into consideration a 50-50 portfolio of Entergy and the S&P 500. As we can see, it still has quite a bit of volatility in the standard deviation and coefficient of variance. They don't complement each other as much as Entergy and Freeport. That is because they are both correlated positively and not negatively. So when the market goes up, so will Entergy, but when it goes down, the same will happen. Randomly selected stocks. What will happen if an investor continues to choose random stocks? Well, they're pretty much gambling their money because they're not diversifying properly. Now, there's two main types of risk: diversifiable and market risk. Diversifiable risk is the type of risk that pertains mainly to a stock or an industry and can be counterbalanced by investing in another stock, while market risk is pertains to the entire market, such as inflation rate, tax rate. This graph here is the market security lines. And what they do is basically correlate the market returns with that of the stocks. The slope of these lines help to indicate the beta of the stock. Should investors buy Entergy stock? Yes, the stock is currently giving a higher return for the risk that it is taking. Consequently, it is currently undervalued. The effective market hypothesis. This hypothesis assumes that all the information that is currently available to the public is already integrated into the price of the stock. So, with that said, it is virtually impossible for an investor to try to surprise the market with new information and beat the market. So the hypothesis states that in the long run, it is near to impossible to outperform the market. In decreasing long-term debt to total assets, the company is basically minimizing risk of default. And so their beta will also decrease